Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams. Today, we are running through the April 2025 macro market update. A few things have happened throughout the month, so stay tuned and we'll get straight into it. So, I like to start by recapping on the 18-year land cycle framework. This is the core philosophy of how I invest is around the framework of the underlying land market. We are on the blue marker, 12 months, 11 to 12 months away from peak market, where we'll see the likes of Brisbane, Perth, Adelaide top out and their respective regions, such as South Australia, regional Queensland, WA, and the likes of Darwin. For that reason, we're no longer looking to invest in those markets, as when the market turns, the demand will shift back to Sydney and Melbourne, and Sydney and Melbourne will then be the leading markets again. So we are sowing our seeds now in certain products, certain suburbs across Sydney and Melbourne in preparation for their next growth run. So don't get carried away with the herd. With all the euphoria, the fear of missing out, it tends to suck in a lot of the mainstream towards the tail end of the boom. And that is when it's most dangerous to enter markets, when they have been going consistently strong over the last couple of years. So this is where we're heading. And more so from a macro level, I like to start with, we'll run through this, and then in the future videos coming through to you, I'll dig further detail into the actual data of both the metros and the regions. But this is the overall framework, and this is where I see we sit in the market, being equivalent point of time 2006, 12 months away, give or take, to peak market. Come 2027, 2028, you'll know about it. We'll be entering the next land-driven downturn, which will be like the 91 recession we had to have. When Paul Keating was in power, Labor government, so very interesting times. We are seeing history repeating itself just like clockwork. So with that said, we'll run through what to expect from Labor government, Anthony Albanese 2.0. We can expect much of the same this time round, with high migration rates. He's not letting go of that. If he does, the economy will dip into a recession. He knows that. Our productivity has been the lowest in decades. So in order to continue to force demand, he's importing all these new migrants. Migration's great for property investors, plays in the hands of property investors. It puts massive strain on not only infrastructure, but the housing sector. The construction and property industry can never keep up with that demand. It is a demand issue. This whole housing crisis that you hear about, it's got nothing to do with the houses or how expensive property is. We can find dirt cheap property around the country. It's a demand issue. There's more people coming in, pushing up rents, as there is a continually growing demand for housing stock, and the construction, property industry and investment can never keep up with that demand. We'll also see green energy policies. This is going to continue to keep upward pressure on power bills, gas bills. So the higher cost of living is not going away anywhere soon, and it's only going to get worse as we continue to work our way through the final stage of the land market, as the land price continues to boom into 2026, 2027. This will obviously inflame the situation, having green energy policies, shutting down power plants, underutilizing our gas resources. This is only going to put ever more pressure on people's budgets. big government spending. So they're throwing money at their green energy policies by giving handouts to people. That's ultimately going to all get soaked up in the benefit of land price. Wiping student debt, help to buy scheme to helping people now buying property 30% down. The government's talking about putting in for established 40% down contribution for new, for people who are looking to get into the market for the first time. These are new schemes that have never been tested in the market, and ultimately it's going to send the land market to its top, because every boom, prior boom to a big land driven downturn, so every boom like we are in now dwarfs the one before, and every land driven downturn dwarfs the one before. So this boom that we are towards the tail end will dwarf what was between 2002 to 2007, and then the next land driven downturn will make 2008 and 1991 look like nothing. This one's going to be a big one, especially when we've got a Labor government in power, rubbing insult into injury with these policies. So they're forecasting budget deficits, so big spending, creating more debt into the system. That's inflationary. That'll also continue to push up house prices. You need more credit, more money to buy the same stock. The house that was built in the 50s hasn't changed. Maybe had a lick of paint, but these days you need more currency, more debt to buy it, because government creates inflation from creating these massive budget deficits. So we'll continue to see sticky inflation and interest rates. I suspect rates may come down once or twice, but that's then potentially going to set off another wave of inflation, and they'll probably be chasing their tail towards the final market top out in 26, 27, which will ultimately give that froth top, which was what we see towards the tail end of a cycle where it sucks everyone in. Everyone thinks we are on the next wave, and we are moving through a new cycle, and it typically comes out of left field when no one sees it coming. So the banks are pricing in rate cuts, so that's going to ultimately feed on confidence. They could even be just pushing that content to drive more optimism, because ultimately they got vested interest to lend money. They want to lend more money because that's their business. So that's something to be conscious of. But if rates do come down, I suspect it will kick off another wave of inflation. Unrealized capital gains tax, I mean, they're starting this with super balances of more than 3 million. So fingers crossed that they don't push for anything more radical and look to make that broader outside of super, or lower the $3 million threshold, because that will really hurt the markets. Ultimately, that will probably be the catalyst of kicking Labor out by the end of this market cycle. And it breaks my heart to say, but lack of international security. We've got China warships cruising around Australia. It is becoming more evident that history could be repeating itself. I'll do another video on this, of wars, history of wars, and how they tie into the land market, and potentially where a war could be coming post the next land-driven downturn. But the writing's on the wall. We are potentially heading that way. So that's what we can expect from a Labor 2.0. A little bit further, this budget that was released prior to the election is now going to be etched into stone. So rental assistance, 10% increase. So that's going to push up rents. Those higher rents will get capitalised into higher prices. So that'll play into the hands of landlords, even though they think it's going to increase the living standard of the tenant. It won't. It's called economic rent. When you have more to spend, they will spend it. So rents will rise. Second to that, income tax relief for low income earners. Again, higher earnings, most of lower wage people on lower wages pay rent. So they'll ultimately also push up rents. 2-year ban on foreign buyers. So they can continue to flock in, but they can't buy any stock. So they're going to be pushed into the rental market. Again, that's going to put even further pressure on rents. And we will see it. It'll become the renters versus the baby boomers, that inflamed, or the renters versus the landlords, that inflamed aggravation between, polar opposites, where we see towards the tail end of a land boom, left versus right as well, will be further and further more exacerbated as the market plays out, but then also with these policies, because ultimately it's going to push up rents. Housing boosts supply. So, I mean, that's throwing money at the housing market to try and boost more supply. That'll contribute to new and off the plan or build to rent stock. So that will help ease a little bit, but reality is 1.2 million homes, very ambitious. I mean, the biggest developer in Australia builds 2,000 or 3,000 homes every year. So how can we expect the government to build more? It's a pipe dream, but at least they got targets. Help to Buy scheme. I mean, this is another big one that's just going to push up prices at that entry level stock where we like to specialize in. Government is now providing money to first home buyers, 40% for new, 30% for established, and allowing first home buyers to enter the market with as little as a 2% deposit. That's going to feed on the entry level stock, and it's going to push up demand in that space. And all this will contribute to a 27 odd billion deficit. So that will continue to erode the currency and require more cash, more debt, more credit to buy the same stock. So we'll continue to see house prices and rents continue to soar over the next few years. Australian inflation rate has dipped into the target band of 2 to 3%. The trim mean inflation recorded a 2.9% rate as of March. This is new data, just been released this month. It's trending in the right way. If you can see on the screen, you'll see that the all group CPI has flatlined at 2.4%. So it is sticky. Whether or not it will continue to get down to sub 2% or that, maintained at 2.5%, I don't believe so. Not until later in the decade, 28, 29, 30, when the market enters the land-driven downturn. That's when we'll see inflation come back down. So I suspect it's going to remain sticky, remain where it's at. So the RBA may not be able to drop rates really super low like during the mid-cycle slowdown, also known as COVID. They might drop it once or twice, but ultimately that'll kick off another wave, as we are still in a very strong expansionary phase of the cycle, and not until after 2027 where we'll see inflation come right back down again, and then followed by interest rates. Unemployment rate, so it's hovering at 4.1%, still at relatively low record levels. However, it is starting to trend up. As you can see, it is a started trend, and you'll find if you look back at history that once it starts to trend up, it doesn't ever tend to go back down, and at some point it'll run to as high, if not higher, than what we saw during the mid-cycle slowdown, also known as COVID. in 2020. I'm suspecting unemployment will get up to over 10% in the next land-driven downturn come 2027. The Reserve Bank of Australia is obviously keeping a good watch on inflation and the unemployment rate, but they've held the cash rate at 4.1%. Banks are starting to pass on those rates. You can get rates as under 6% these days. And the next update from the RBA is scheduled for the 20th of May. So 2 or 3 weeks away. So we'll see if we see a further rate cut on the horizon. Time will tell. And this is an interesting new slide of data I've pulled from the ABS. It illustrates domestic demand at a state level. So at a high level, we can see that the strongest states currently are the Northern Territory is the strongest state with the most domestic demand, and WA. That's pushed by the mining sector. Mining sector tends to run in the later stages of the cycle as construction property industries globally start to kick into gear, drawing on Australian commodities, our resources. That sets off the mining sector, which pushes domestic demand in these markets as people are flocking there, doing fly in, fly out work on big bucks. Ultimately, that will all soak down to the benefit of land price, which is why we're seeing in Perth, WA, Northern Territory, and Queensland that the property markets are away at the races. And we can see that Victoria, New South Wales, more balanced. Queensland, South Australia and ACT are in negative, so they look to be topped out and entering a bit of a downturn where we're talking domestic demand. But what I thought was quite interesting is if you can compare public versus private fixed capital formation. So basically how much money is coming from the private sector, private businesses, investment versus the public sector. And we can see that there's, from a private perspective, that's probably the best indication of where a market is heading. Looks to being reduced capital out of Queensland, South Australia, Tasmania, ACT, and the most capital is going into currently Northern Territory, followed by WA, Victoria, and New South Wales. So very interesting to see where the private capital is flowing. Second to that, public capital being the government. Government is pulling out of South Australia and Northern Territory. They can probably see the amount of private capital going to the Northern Territory, so they're pulling out of that market. And they're pumping money into Tassie, WA, and Queensland, followed by Victoria and New South Wales. So interesting. That's a leading indicator to see where markets will be heading in the years ahead, because ultimately everything gets soaked up by the benefit of land price and property prices. What's happening in the States? The first 100 days of Trump saw a cutoff in migration on the southern border. That'll be reduced domestic demand for the US. That'll be disinflationary in the US. It'll reduce demand on the infrastructure and housing market. They've deported nearly 70,000 criminals. They've got a 145% tariff on China and no deal cut yet. So basically cut off China from doing any business with the US. That's pushing China's economy into a recession. That'll ultimately have a flow-on effect to Australia, as Australia has a lot of exports that goes to China being coal, natural gas, iron ore, which ultimately comes out of WA, Queensland, and Northern Territory predominantly. So those markets will not be saved like what we saw throughout the GFC. So I suspect this time around, those markets are going to get hit harder than the growth they experienced from around, say, 2006-7 all the way through to 2013, 2014. They pretty much bucked the trend of the GFC and didn't slow down until around that 2013, 2014 mark, and then went through a downturn for a good 10 years. So we probably won't see that this time around, as China's not there to save those markets. So that's why I'm very wary of continually buying in those markets, and we're not. We pulled out of Queensland in early 2024, as I believe they are getting a bit of final sugar hit with all the optimism and the fear of missing out. The stupid money, I like to call it, are flowing into those markets, but the setup is here for a larger downturn than what was experienced historically. So very interesting times. He's cutting deals with all the other countries, so time will tell. See if we can see Albanese cut a deal and remove the 10% tariff and also the 100% tariff on movies. So ultimately, that the tariffs will be manageable by Australia. Those markets, more so the farmers, will have to increase their price of their products, and that inflation will ultimately increase in the States and potentially even reduce inflation in Australia, as it will reduce demand. Inflation is coming down in the US, driven by their energy policy. Drill, baby, drill. He's pumping oil to dominate the energy markets globally to reduce inflation so you can try and push rates down, but also using it to have leverage over Russia so they don't have money to continue to keep funding the war. He's made commentary, Trump that is, on replacing Jerome Powell come May 2026, as he is not dropping rates as quick as he would like. That's obviously going to pump the markets if he gets someone in there that will do what he says. And he's cut a minerals deal with Ukraine, allowing the US to set up mines in Ukraine to mine minerals, oil and gas, to pay off the contributions they've funded Ukraine to defend the war, and also to create peace within that region to keep Russia out of Ukraine. Once this stabilizes, I feel this will set off the final euphoria in the markets, where people have confidence that rates are coming down, that the wars are ended, and we'll find that final shoot to the stars prior to the land-driven downturn. So with that said, inflation in the US has dropped significantly in March, down to 2.4% from 2.8% in February. They have a target, though, of 2%. So they don't have a band of 2 to 3%. So hence why Jerome Powell isn't forthcoming with interest rate drops, but I'd suspect it's on the horizon, as Trump is already talking about replacing him. So he may be forcing his hand to drop rates sooner rather than later. And unemployment is starting to tick up a little bit, up to 4.2% from the low of 4.1 in the prior month. Similar to Australia, starting to trend up slowly. So this is something we'll watch quite carefully, because once this starts to run, it'll indicate that we are entering the land-driven downturn. This is the Federal Reserve funds rate. They're holding at 4.5%. And why I like having a good study on the US markets and what's happening in the US, because the US leads the land market, the 18-year land cycle. And historically, Australia trails 6 to 12 months behind. So whatever happens in the US, we can expect that Australia will follow suit within 6 to 12 months. So if rates start coming down in the US, we can expect the same for Australia. And stock markets are back rallying again after the short, sharp correction we saw over the last couple of months as Trump was spooking the markets with his trade policies, his tariffs. But once the mainstream started to understand that he was only using it as leverage, and most of the tariffs won't actually be held consistently over the long term, he'll create free trade agreements that ultimately are good deals for the US, but he uses tariffs as a mechanism of leverage, hence why he's getting all the countries around the world lining up at the White House. So that realization to the markets has sunk in, hence why we are now seeing the stock markets rallying in the US, the Dow Jones, the FTSE, the UK stock market almost back at all-time highs, and the ASX 200, the Australian stock market. I said a couple of months ago that, or during the turmoil last month, that I believe we will be in all-time high stock markets by the end of 2025, and it's well and truly looking like it's playing out that way. US home builders, however, are in the background. These are the largest, one of the largest, two of the largest US home builders in America. Their stock prices are slowing or easing, falling, and they'll continue to do so, I believe, just like what happened from around 2005-06 in the background. Meanwhile, the rest of the markets continue to keep charging ahead. These home builders are pricing in reduced earnings, hence why their share prices are falling, as their revenues and their profits are forecasted to slow in the coming years, as they are pricing in the land-driven downturn. So these are a key leading indicator we like to watch. And based off history, they lost about 85% from peak in around 2005 to trough come mid-2000, June 2007, before the overall markets topped out and then started a downturn in September, October 2007. So we are probably a third way through the decline, or even coming up to a half, or probably a third. So we're keeping tabs. And as we approach that 78% decline, that could be a leading indicator for the overall markets to start their correction, like what we saw from October 2007 to 2010-11. Bitcoin is holding steady and looks to have started to come back from its slight correction over the last couple of months. Again, Bitcoin will probably be an all-time high by the end of 2025. And it's anyone's guess if it will survive, along with all the other Bitcoins, crypto coins, come 2027, 2028. It doesn't have anything behind it other than the blockchain. But does anyone really know what the blockchain is? So when the market turns and there's more sellers than buyers, as people will be wanting their cash, it could potentially go to zero. It's not a hard asset. It's not like a house, a block of units where you've got bricks and mortar, you've got a title, you've got land, you've got something. Bitcoin is just more buyers than sellers currently. But when the market turns, the land-driven downturn will be the ultimate test for not only Bitcoin, but cryptocurrency as a whole. Thanks for watching. I hope you enjoyed that. If you find any value with that, shoot it to someone you would appreciate a macro market update based on the 18-year land cycle. This is how I can correlate where we are heading based around the framework of the 18-year land cycle. So you can see sense of what is actually happening in the world rather than jumping at shadows. You can have clarity. I like to provide clarity to not only myself, but my clients, as I can help them build their long-term sustainable residential foundation portfolios, all-weather portfolios, as when the market turns, there will be products that will be actually going up, which won't be commercial property, won't be all the shiny stuff, won't be all the blue chip stuff. That stuff is going to get hammered. It'll be the affordable entry-level stock, affordable housing. The demand shifts during times of crisis to the affordable end of the market, and that's the market and the type of stock we like to specialize in to capitalize on the coming downturn and also to protect yourself. There's always a demand and there's never enough supply of affordable housing. So if you want help building a large, sustainable, rock-solid foundation portfolio, 10 properties within a 10-year window, I can help you. Until next time, don't forget to subscribe, like, share, leave me a comment, shoot me an email if you want help or you would like to provide some feedback. Thanks for watching. I'll see you on the next one.